Hello and welcome to this podcast. This podcast is the first in a series in which we identify and examine the different elements of the gross income definition. Gross income is significant because in many ways it's the starting point for all tax. If you don't have gross income, then simplistically speaking, you don't have any taxable income against which you have to pay tax. So we're going to have a look at the gross income definition, and in this podcast we're going to focus on the definition of resident. So gross income, in terms of the definition in section 1, means in any period or year of assessment. In the case of any residence, the total amount in cash or otherwise received or accrued to or in favour of such resident, or in the case of any person other than a resident, the total amount in cash or otherwise received or accrued to or in favour of such person from a source within the Republic, during such year or period of assessment, excluding receipts or accruals of a capital nature, but including ... and that's where the special inclusions come in. So the first thing that we can see is there are two different definitions, one that applies to residents and one that applies to persons other than a resident. So in this podcast we're going to deal with what is a resident. From that definition we can see that a resident must include their worldwide income in their South African gross income. A non-resident, however, only includes income from a South African source. Residence is determined by, in the case of individuals, firstly, whether or not that person is ordinarily resident in South Africa, or if they are not ordinarily resident in South Africa at any point in the current year, by the physical presence test. Now, if they are ordinarily resident for any part of the year, we don't go on to the physical presence test. So the physical presence test is only for people who are not ordinarily resident. So what does ordinarily resident mean? Well, there have been a number of court cases where this has been debated, and the key elements are the following. Being ordinarily resident in South Africa is not the same as being a citizen of South Africa. It doesn't mean you've got a South African ID document, it doesn't mean you've got a South African passport, it doesn't mean that you own property here. It has got nothing to do with any tick box exercise that you could say, I want to be a resident or I do not want to be a resident for tax purposes. In the following two cases, the court has essentially said that whether or not you're ordinarily resident is a question of your state of mind. And in Cohen, the court said that the country in which you're ordinarily resident is the country to which you would return from your wanderings. What happened was Mr. Cohen was a director for OK Bazaars and he was sent over to the United States, and while he was over there he earned interest and royalty income from South Africa. He argued that since he hadn't been living in South Africa during the year of assessment, he couldn't be ordinarily resident. The court looked at his circumstances and said that it was quite clear from his circumstances that it was always his intention to return to South Africa. He had only been sent initially for 9 months. Those 9 months had been extended by a further 12 months. But it was quite clear that he was going to come back to South Africa. The place to which he would return from his wanderings was South Africa, and while in the United States, he was essentially on one of these wanderings. CIR versus Cattell was the opposite. Cattell was also sent by his company to the United States, and he was to explore business opportunities there. But unlike Cohen, he settled much more permanently in the United States. He rented property there, he bought a car, he opened bank accounts, he joined a church, he obtained a social security number, and eventually he actually became a resident or obtained citizenship in the United States. And although SARS tried to argue along the lines of Cohen where they'd been successful, in Cattell's case the court said it was clear that Mr. Cattell had changed his country of residence. He was no longer ordinarily resident in South Africa, but the place that he was now habitually and normally resident was the United States, and that was the place that he was ordinarily resident. So it is possible to remain ordinarily resident in South Africa even if you're not physically in South Africa, and likewise it is possible to change your country of residence even if you were not born in that country originally. If you become a resident under the ordinary residence test, or if you cease to be ordinarily resident, then you are treated as resident or ceasing to be resident from the date that those criteria apply or cease to apply. So on the day that you become ordinarily resident in another country, you are stopped being treated as a resident in South Africa. The fact that you might have occasional absences from your country of residence does not mean that you are no longer ordinarily resident in that country. And likewise, whether you are ordinarily resident or not has very little to do with the number of days that you are present in the country. So that's the ordinary residence test, and we'll have a look at a few examples. So for instance, Mr. X lived in South Africa throughout the 2012 year of assessment. On the 1st of March 2012, start of the 2013 year of assessment, Mr. X moved to New York on an 18-month secondment. He will return to South Africa at the end of 18 months. Is Mr. X ordinarily resident in South Africa? I think we can see from the debate of Cohen and Cattell that he remains ordinarily resident in South Africa. In contrast, Mrs. Y lived in South Africa throughout the 2012 year of assessment. On the 1st of March 2012, Mrs. Y left South Africa to take up a new permanent employment position in New York. Mrs. Y sold her car and her house, bought a house in the suburbs surrounding New York, and enrolled her children in school there. Is Mrs. Y ordinarily resident in South Africa? I think there we would say no. Her example is more like that of Cattell than it is of Cohen. And finally, Mr. Z has been in South Africa for the past 2 years. He's a professional soccer player, and this year his application for citizenship was fast-tracked so that he could represent the South African national soccer side. He is now a South African citizen. However, he intends returning to his home country as soon as his international career is over. Is Mr. Z ordinarily resident in South Africa? This one is a little more difficult, and I'm not going to tell you what the right answer is. The two things that I do want to point out, though, is the fact that he obtained citizenship in South Africa does not automatically mean that he is ordinarily resident in South Africa. Likewise, the fact that he intends going to some other country at some point in the future, even his home country, doesn't automatically mean that he is still resident in that other country. He must have some practical link to his home there. It can't just be a wish, a hope one day that those are his plans are. We must be able to say, if he was to return from his wanderings, where would he consider his home? So that's ordinary residence, and ordinary residence is a state of mind. You can see from that, though, that it might be easy to manipulate where you're ordinarily resident. And you could make sure that you're not ordinarily resident in South Africa in order to avoid paying tax in South Africa. So the second test was introduced, and that's the physical presence test. The physical presence test has nothing to do with your state of mind. It is a matter of fact. It is only used if you were not ordinarily resident at any time during the current year of assessment. If that is the case, you may still be treated as resident if you were physically present in South Africa for 91 days in the current year of assessment, or more than 91 days, more than 91 days in each of the preceding 5 years of assessment, so you have to be in South Africa consistently for 6 years, and more than 915 days in aggregate in the preceding 5 years, so excluding the current year. If you divide 915 by 5, you'll get 183 days. So we're saying on average, you must have been in South Africa for more than 6 months in every year in the past 5 years. If you meet all 3 of those criteria, you will be treated as resident from the beginning of that year. And you'll be treated as resident until the end of that year. That's different from the ordinary residence test. The ordinary residence test can begin or end in some point during the year. Physical presence test, if you meet the physical presence requirements, you're treated as resident for the whole year. The only time it could be less than a full year is if you leave the country and you remain outside the country for at least 330 continuous days. Then you will cease to be treated as resident from the day that you left. Really what you're saying there is, I've left and I'm not coming back. So the way that I'm treated should now change. Let's have an example of the physical presence test. So Mrs. P was ordinarily resident in South Africa from 2008 to 2011. In 2011, she moved to London, where she has lived for the past 3 years and where she is considered ordinarily resident. So we know that she's ordinarily resident in the UK. However, every year she returns to South Africa to spend the summer here. 2 years ago, she spent an extended period of time here because her mother was ill. Her time in South Africa has been as follows. 2008, 9 and 10, she was here for the full year. 2011, she was here for 185 days, and that's when she moved to the UK. In the 2012 tax year, she was here for 101 days, and in 2013, she was here for 93 days. Is Mrs. P resident in South Africa for 2013? And if so, for what proportion of the year? Well, we know that she's not ordinarily resident in South Africa because they've told us that. So we have to apply the physical presence test and say that she was in South Africa for more than 91 days in the current year of assessment, more than 91 days in each of the previous 5 years of assessment, and more than 915 days in total over the previous 5 years of assessment. Therefore, she is treated as resident in South Africa in 2013, and because it's the physical presence test, she will be treated as resident for the whole tax year. Secondly, would Mrs. P have been resident in 2011, and if so, for what proportion of the year? Well, 2011 was the year that she moved from South Africa to the UK. So she would have been resident in 2011 because of the ordinary residence test. And because we're applying that test, she would only be resident for a portion of the year. That would be the 185 days until she changed her country of residence. So those two parts to the example highlight the difference between the physical presence test and the ordinary residence test. So far we've had a look at residence of individuals. Let's have a look at residence for companies. A company is resident in South Africa if either of the following two apply. If it was incorporated or formed or established in South Africa, then it's resident in South Africa. Or if it has its place of effective management in South Africa, then it's resident in South Africa. Now there's two opinions as to what this place of effective management means. Everyone agrees that place of effective management means where your management decisions are taken. So not decisions like what dividends to pay, directors to be appointed or fired, not where your AGM is held, where your business decisions are taken. But from there on, there are two opinions. CSARS takes the opinion that it's where your day-to-day management decisions are taken. What stock to buy, what suppliers to use, what prices to charge. The decisions that are closely linked to the actual day-to-day operations of the company. CSARS likes that approach because it's very difficult to separate that from the physical location of the operations themselves. The OECD model is different. The OECD believe that the place of effective management is where your top decisions are taken, your top management decisions. That's a little bit more easy to separate from your actual operations, and so for that reason CSARS don't like that approach. We know that CSARS would apply the approach that I've highlighted to you. We don't know for sure whose interpretation is correct because no one's ever gone to court to test this. So for now, we have two possible interpretations. There are some exclusions from the definition of resident. The one that I'm going to highlight to you is the first one on the slide, and that is if you are deemed to be exclusively resident of another country in terms of a double tax agreement between South Africa and the other country, then you will be excluded from the definition of resident in South Africa. That's as far as we're going to go on residence. If you are not resident in South Africa, then you are only taxed on your South African source income. So in the next podcast, we're going to have a look at what South African source income means. Thanks for watching. Hello and welcome to this podcast. This podcast is the second in a series in which we examine the definition of gross income. In the first podcast, we had a look at what it means to be resident in South Africa, and in this podcast, we're going to look at what it means to have income from a South African source. The starting point for source is Section 9 of the Income Tax Act. Section 9 has a number of specific rules that deal with different types of income and what that source is going to be. If we have a type of income that doesn't fall within any of the rules of Section 9, we would have a look at case law and say what are the general principles of source and how do those apply to our specific scenario. Section 9 has got two sections that sort of mirror, or two subsections that sort of mirror each other. Section 9.2 deals with what is from a South African source, and Section 9.4 deals with what is not from a South African source. And essentially Section 9.4 says for each of the Section 9.2 sections, if income does not fall within the South African source rule for that type of income, then it's not from a South African source. So there's no second bite at the cherry. If your income is not from a South African source in terms of Section 9.2, and it's a type of income that's dealt with in Section 9.2, then it's not from a South African source. So these are the rules. Section 9.2a says that all South African dividends are from a South African source. In actual fact, what it just says is that all dividends are from a South African source, but dividends are defined as South African dividends. We've got a separate definition for foreign dividends. So all South African dividends, i.e. all dividends from South African companies, are from a South African source. Section 9.2b deals with interest, and it says in deciding what source interest is from, look to the payer of the interest. Is the person paying the interest either a resident, or are they using the funds in South Africa? If either of those two are true, then your interest income is from a South African source. It doesn't matter where the money is lent from, it doesn't matter where the contract is concluded, it doesn't matter whether the recipient is a resident or not. We look at the person incurring the interest. The one exception to this is if the interest is incurred by a resident of South Africa, but it's incurred by a permanent establishment of that resident, and that permanent establishment is outside South Africa. Simplistically, a permanent establishment is like a branch. A branch is not a separate legal person from the person who owns the branch, but it is capable of operating independently. And it's treated almost like it's a separate person, even though in law it isn't. But excluding that exception, if a resident incurs interest, then that interest is from a South African source, and if the funds are used in South Africa, either by a resident or a non-resident, then that interest is from a South African source. Section 9.2c and 9.2d deal with royalties, and the principle is similar to that of interest. If the royalties are incurred by a resident, or the royalties are in respect of the right of use of the underlying intellectual property in South Africa, then that royalty is from a South African source. It doesn't matter where the intellectual property was initially developed, it doesn't matter who's receiving the royalties, we look at who is paying the royalties. 9.2e and 9.2f are similar. They deal with specialist knowledge, and again you look at the person receiving the specialist knowledge. Are they a resident, or are they going to use the specialist knowledge in South Africa? If either of those two are true, then the related income is from a South African source. Section 9.2g says if the income is in respect of a public office appointed by Parliament, so if we have a foreign secretary working for the South African, or appointed by the South African Parliament and working overseas, that income is still from a South African source, even though they're rendering their services outside the country. 9.2h is similar. If services are rendered to the government, then income in respect to those services is from a South African source, irrespective of who renders the services and where those services are rendered. Those two, 9.2g and 9.2h, seem to make sense. If it's the South African government paying the money, it makes sense that they should be able to tax that income as well. 9.2i says a pension is from a South African source to the extent that the reason the recipient is entitled to the pension is due to services that they rendered in South Africa while they were employed by the person now paying them the pension. So we don't look at where the person receiving the pension is now, nor do we look at who the person paying the pension is. We look at what were the services rendered in the past that give rise to the pension now. 9.2j and 9.2k deal with disposal of property, assets. 9.2j says if immovable property is located in South Africa, then the proceeds on the disposal of that property is from a South African source, irrespective of where the buyer or the seller are located, irrespective of where the contract is concluded, irrespective of where the money is paid over. If the property is in South Africa, then the proceeds are from a South African source. And included in that definition are shares in property companies. So if a company owns a property, and essentially that property is the only asset of that company, it's the only thing giving value to those shares, and someone sells those shares instead of selling the underlying property, then that income will be treated according to the rules for property, immovable property, and not according to the rules for shares. So you can't get around the immovable property rules by putting your property in a company and selling the company instead of selling the property itself. 9.2k deals with the disposal of movable property, and it says that the disposal of movable property by a resident always gives rise to South African source income unless that property is attributable to a permanent establishment, i.e. a branch outside of South Africa. And for non-residents, it's the opposite. The disposal of movable property by a non-resident does not give rise to South African source income unless that non-resident is selling property attributable to a permanent establishment that's in South Africa. And 9.2l deals with exchange differences, and it says that all exchange differences earned or incurred by a resident are from a South African source unless attributable to a permanent establishment outside South Africa, and all exchange differences earned or incurred by a non-resident are not from a South African source unless they're attributable to a permanent establishment inside South Africa. So that's the end of 9.2. 9.4 is the opposite to 9.2. So 9.4a says that foreign dividends are not from a South African source, and it defines what a foreign dividend is. 9.4b says that interest is not from a South African source unless it meets the requirements of 9.2b. 9.4c says royalties are not from a South African source unless they meet the requirements of 9.2c or 9.2d. 9.4d says that proceeds on the disposal of an asset is not from a South African source unless it meets the requirements of 9.2j or 9.2k. And 9.4e says exchange rate differences are not from a South African source unless they meet the requirements of section 9.2l. So section 9 has all the specific rules dealing with specific types of income. They don't have rules for every kind of income, and if there is not a rule for a specific type of income, we look to the case law principles that outline what source means and how to identify it. And the general principle comes from the case of CIR versus Lever Brothers and Unilever. And in that case, they said, look at the originating cause of the income and look at where that cause was located. And that is how you identify the source. So if you earn remuneration, salary income, look for the originating cause. The originating cause is the services you render, and look at where those services were rendered. Wherever the services were rendered, that is the source of that income. Now, services rendered, remuneration is an easy example. It is possible to have more complicated examples. For instance, what if a product is manufactured in one country, marketed in another country, sold in a third country? Which one of those activities gave rise to the income? Well, the answer in CIR versus Black is the court has told us we must look for what is the dominant cause. What is the cause that brings the most value to that income? That dominant cause and the location of that dominant cause will be the source of that income. So that's as far as we're going to go on source. Next, we're going to have a look at the rest of the gross income definition, starting with total amount in cash or otherwise. Thanks for watching. Hello and welcome to this podcast. This podcast is part of a series in which we examine the definition of gross income. So far, we've looked at what it means to be a resident in South Africa for tax purposes and what it means to have income from a South African source. In this podcast, we're having a look at amount in cash or otherwise. This part of the definition is important because if you don't have an amount that can be established, then you do not have gross income. One of the earlier cases in gross income debates was around whether an amount must be cash or not in order for there to be an amount. And in CIR versus Lategan, the court said we're trying to have as wide a definition as possible. So every form of property which has a money value is potentially an amount for the purposes of gross income. We then found that it must be an amount that's expressible in money in order for there to be an amount. In CIR versus Butcher Brothers were lessors of property, and as part of the rental agreement, they were entitled to improvements by the lessee. The lessee made those improvements, and SARS tried to include that in gross income. And the court said that it was not possible to put an amount to what Butcher Brothers had received. They hadn't received the improvements because they weren't entitled to use them until the conclusion of the lease. And no plausible way had been put forward of how to put a value to what they had received. Now, looking forward, we know that there is a special inclusion to deal with leasehold improvements, but the reason that's there is because the general definition doesn't bring it in because we can't put an amount to it. In Commissioner for SARS versus Brummeria Renaissance developed old age homes, retirement complexes. And instead of selling the units to people who wanted to retire there, they allowed the tenants to live in the units rent-free. They gave them a life right to live there for as long as they wanted to, rent-free. And in return, the tenants had to provide Brummeria Renaissance with an interest-free loan. Brummeria then argued that that wasn't gross income because a loan does not represent gross income, and that they hadn't received anything in cash or otherwise. The court found that they had received something. What they had received was the right to an interest-free loan, and it was possible to express the value of that right in money. And the value of that right was the interest that they would have had to pay if they had borrowed that money from a third party instead of from their tenants. In return, Brummeria had obviously also provided rent-free accommodation to the tenants, and that also had a value. There was then a question about whether all interest-free loans would then give rise to gross income, and SARS, after a while, came out with its interpretation where they said that they would only pursue interest-free loans where the recipient of the loan was providing something in return for that right. Now, when we're trying to put an amount in money to what has been received or accrued, we must look at what the true intention of the parties is. That comes from the case of leased proprietary mines. In that case, leased proprietary mines were selling a mine, and in return they were receiving shares in the company that was the buyer. And the way they structured the contract was that the price that they put on the mine was the par value of the shares multiplied by the number of shares that they were entitled to receive. That created an artificially low value, because in actual fact what they were transacting on was obviously not the par value of the shares, but the market value of the shares. Market value was considerably more, so actually what they were receiving was a lot more than par value. The court said the intention of the parties is not to contract at the value in the contract. The intention is to receive shares, and those shares are at their market value. So leased proprietary mines had to include a much larger amount in gross income than was the value that was nominally put in the contract. And finally, total amount in cash or otherwise excludes notional amounts. So you cannot have something included in your gross income based on what you should have earned or could have earned. What you've actually received or accrued is what is included in your gross income. So if you choose not to put your money in the bank, you can't be taxed on the interest that you could have earned if you had put the money in the bank. You also can't be taxed on the higher price if you could have sold what you sold for more than you in fact did. It's about the actual amount, not notional amounts. In the next podcast, we're going to have a look at what received or accrued means. So I hope you'll join us for that one. Hello and welcome to this podcast. This podcast is part of a series in which we examine the gross income definition. In this podcast, we're looking at the meaning of received or accrued. An amount should be included in gross income when it is received or accrued to the taxpayer. In CIR versus Delfos, the court clarified that the amount must only be included once, and it's at the earlier of receipt or accrual. This was tested in SIR versus Silver Glen Investments, when the receipt and the accrual happened in 2 different years, and it would have in fact been better from SARS's perspective to include it at the later of the two, because in between the 2 events there had been changes to the tax legislation. The court said it's not up to SARS to choose when to include the amount, it must be included at the earlier of receipt or accrual. There's a question about what received or accrued means in the context of fraudulent transactions and in theft. In MP Finance Group versus the Commissioner for SARS, MP Finance Group was a pyramid scheme or a Ponzi scheme. They were collecting money from investors under the pretext that they were investing it with MP Finance Group, who would make a return on the investment. But in fact, MP Finance Group was treating the money as their own and was unable to repay the investors. The pyramid scheme fell apart. The question then arose, should MP Finance Group recognize any amounts as gross income when they'd collected it fraudulently? And the court said in that example, there is a willing giver who's giving it to the taxpayer. And if that's the case, and if the taxpayer is treating it as if it were their income, then that amount has been received by the taxpayer. Now, in contrast, in Cott versus G, Cott is the Commissioner for Taxes in Zimbabwe, then Rhodesia. G was an employee of the government, and he had access to government funds. And over time, he siphoned off some of that money for himself, and he spent it, and it was subsequently uncovered that he had been stealing money. The question was then, should G recognize gross income, since he had taken this money? And the court said in that example, there was no willing giver of the money. He had stolen it from the government without their consent, and that meant that nothing had been received by or accrued to him. And finally, in CIR versus Delfos Bay Cigarette Company, the question of the legality of the transaction in which the income arose was tested. Delfos Bay Cigarette Company was running a lottery, and part of the purchase price of a pack of cigarettes entitled you to entrance in their lottery. They recognized a portion of the selling price as gross income, and a portion, they said, was for the lottery. It was subsequently decided that that lottery was illegal, and Delfos Bay Cigarette Company said that only the portion of the income that related to the selling of the cigarettes should be included as gross income, since the other portion was illegal and should be then excluded from their gross income. The court said whether the transaction in which the income arose was legal or illegal was not a determining factor in whether the taxpayer had received an amount. The only thing that mattered was there a willing giver and a willing recipient? And in that case, there was. So now we need to go a little bit further into what does received by or accrued to mean, and we'll start with received by. If an amount has been received, and it's been received before it has accrued, then whether or not it has accrued has no bearing on whether it represents gross income or not. If it's been received, it should be included as long as it is for the taxpayer's own benefit, as long as it's their money to do with whatever they want. Now, there are 2 cases that stand on either side of the line of the taxpayer's benefit. In Geldenhuys versus CIR, Mrs. Geldenhuys was the widow of Mr. Geldenhuys, who had been a farmer, and he had left a flock of sheep. He had divided the flock in terms of use and ownership, and he had given the use of the flock of sheep to his widow, and he had given the ultimate ownership in the flock of sheep to his children. So Mrs. Geldenhuys was entitled to use the sheep, presumably to farm for wool, but the ultimate ownership of the sheep rested with her children. Mrs. Geldenhuys then sold the flock of sheep, received the selling price, and presumably passed that selling price on to her children. The question was whether Mrs. Geldenhuys should pay tax on that amount. And the court decided that although she had received it in the sense that it had gone into her bank account, at no stage had she received it for her own benefit. Because she wasn't the owner of the sheep, the money wasn't hers to do with whatever she wanted. She had to pass it on to her children. Now contrast that with CIR versus the Witswatersrand Association of Racing Clubs. The Witswatersrand Association of Racing Clubs decided that they were going to hold a race day and that it was going to be a charity race day. So they would give whatever proceeds they made on the race day to a charity. They duly held the race day, collected the takings at the door, and when all was said and done, they paid that on to a charity. And they argued that they had no gross income because the event had been organized with the intention to give the money to someone else. And the court in that instance said that there are two separate transactions. The first was Witswatersrand Association of Racing Clubs receiving the money. And when they received it, it really was theirs. They could do with it whatever they wanted to. What they in fact did was give it to a charity. But that was a second transaction. It was their money and they were free to make that decision. Different from Geldenhuys, who at no point had any choice over what to do with the money. So the amount must be received for the taxpayer's benefit, means that the taxpayer must be able to do with it whatever they choose. Now there's a question about what about amounts that are received but may be given back to the person giving the money. And again, two cases that contrast what that might mean. In Pyott versus CIR, the question of amounts that are received and might be refundable was examined. Pyott's is a biscuit company, and they were selling biscuits in tins, and they wanted to ensure that the tins were returned to them. So what they did was they said to customers, we will refund you a portion of the purchase price, the sales price, if you bring the tin back to us. And they were taking the selling price, recognizing a portion in revenue, and transferring a portion to a reserve, that reserve being ready to repay the customers when they brought the tins back. They argued that only the amount net of the potential refund was gross income. The rest had not been received for their own benefit. The court said that that was incorrect. At the date of the sale, all of the money was received for Pyott's benefit. They received that money and they could do with it whatever they chose. It might have been prudent of them to put that into a reserve, but the fact remained that at the date of the sale, they had no further obligation to the purchaser. If and when a refund arose, that was a second transaction that was triggered by the return of the tins. But until those tins had been returned, there was no obligation to repay that refund. So 100% of the selling price had to be recognized by Pyott's in their gross income. When the tin was returned, then they would repay the deposit, and that may bring about other tax consequences, but it didn't change the original amount received. Now, in contrast to that, in CIR versus Gen & Co., the court said that when a loan is received by the borrower, that is not gross income for the borrower, because at the date that they receive the loan, they also incur an obligation to return a similar amount of money to the lender. That is not gross income. So what about scenarios where there is a refundable deposit? You enter into a transaction, you pay a deposit. If that transaction is cancelled, the deposit is returned. Well, the only way for the seller in that transaction to show that that amount is not received for their own benefit is to put it in a separate trust account, separate from the rest of their money, and an account which they are not entitled to access and do with whatever they choose. If they're not able to do with it whatever they choose, then that amount is not received for their own benefit. But if they can in the interim do whatever they wish with the money, then the fact that they may have to return it at some other point does not mean that it hasn't been received. An amount is included in gross income at the earlier of receipt or accrual. So if the amount hasn't yet been received, we need to ask the question, has it accrued to the taxpayer? And accrued means slightly different things in tax than it does potentially in accounting. There's been some development in this through the case law, and in Lategan versus CIR, the court said that accrued means entitled, i.e. the taxpayer has performed their side of the contract. Remember again, if they've received the money, then whether it is accrued to them does not determine whether it's gross income or not, so we are assuming that they haven't yet received the money. In CIR versus People's Stores were selling to their customers on interest-free credit. And they argued that at year-end, they were not entitled to the money because they had promised their customers interest-free credit for a period, and that period had not yet elapsed. They couldn't go knock on the door and demand their money, and so they argued that money had not accrued to them yet. The court said that it's not about whether they're entitled to collect the money, it's whether they're entitled to payment. And at that point that People's Stores made the sale, there was nothing further they had to do in the agreement. They were entitled. The court also said at that point that if we're talking about entitled to payment, then the amount that we must value must surely be the present value. And that decision didn't go down so well, so subsequently the gross income definition was amended, and at the end of the gross income definition it now says that where an amount accrues to the taxpayer, it is deemed to accrue at its face value, even though in reality, in the absence of that provision, we would include the present value. So there's no present valuing of gross income anymore. There's a specific proviso that says it's at face value. Going back a step, in Moy versus SIR, Moy was employed at a mine, and as part of his employment, he received options to buy shares. He received them in year one, but he wasn't entitled to buy the shares until the point that the mine was completed and on stream. And SARS argued that because he had received the options in year one, and all that we were waiting to do was for the time to elapse when he could exercise the options, that the gross income should be recognized in year one. The court ruled that that wasn't correct, because at year one, Moy had not completed everything on his side of the contract. He still needed to get the mine on stream and up and running. And so the court said that the taxpayer must be unconditionally entitled before they have gross income. So at the point that they recognize gross income, it must be because they have nothing more to do on their side of the contract. Mr. Moy still had to complete the mine before he could exercise his options. The fact that the taxpayer must be unconditionally entitled to the amount does not mean that the amount itself must be certain. If the amount is uncertain, but it is possible to make an estimate, then it's acceptable to recognize that estimate as gross income and to true it up in later years if it's not 100% accurate. However, if the amount is unquantifiable, then recognition is deferred until the point that it becomes quantifiable. And Section 24M specifically legislates that in relation to the purchase and sale of assets. It says when an amount cannot be quantified, then the tax effects are delayed until the point that it is quantifiable. So that's it for received and accrued. In the next podcast, we're going to look at what it means to have income of a capital nature or not of a capital nature. Hello and welcome to this podcast. This podcast is the last in a series in which we examine the general definition of gross income. So far we've established that South African tax residents include their worldwide income, whereas non-residents include only their South African source income. And we've established that in order for there to be gross income, You need an amount, in cash or otherwise, that has been received by or accrued to the taxpayer. In this final podcast, we look at the final criteria, which is that the amount must not be capital in nature. There's no definition of capital in the Income Tax Act, and as a result, it's been the most fiercely contested of the criteria within the gross income definition. It's important to say that all amounts must be either capital or revenue. There's nothing else within the gross income definition. And whether something is capital or revenue is a subjective item. It's determined by the taxpayer's intention. We can't simply say that all of a particular kind of asset are capital and all of other kinds of assets are revenue. Now, prior to 2001, if an amount was capital in nature, it was excluded from gross income and there were no further tax consequences. With the introduction of capital gains tax in 2001, we must now think about amounts excluded from the gross income definition and what the capital gains tax consequences of those amounts are. In Pyott, the court clarified that there's no halfway house between capital and revenue. An amount must be one or the other. It is, however, possible to say that a single amount received represents part capital and part revenue. There's two questions we now need to answer. First is, what is capital? How is it defined? And the second is, how do we determine whether something is capital or revenue in a particular context? So we'll begin with, what does capital mean? And the overarching definition that we can extract from case law is that capital produces either revenue or benefits. The most commonly given analogy is that of a tree and its fruit, and that comes from CIR versus vCIR. And the analogy is that a tree produces fruit in the same way that capital produces revenue. You don't plant a tree because you want a tree, you plant a tree because you want to get the fruit. In the same way, a capital asset is not pursued for its own sake, it's pursued for the revenue that it will bring in. In CIR versus George Forest Timber, they were talking about the balance sheet, and they said within the balance sheet we've got fixed capital and floating capital. Fixed capital is that capital that goes onto the balance sheet once and remains there. Buildings and machinery, things that are used in the business. Floating capital is that which gets recycled over and over again. So money buys trading stock. Trading stock leads to sales. Sales lead to money in the bank. That money is used to buy more trading stock. It gets frequently recycled, and that is floating capital, which is revenue in nature. Then in W.J. Verriebe-Lachens, they said that capital represents the income earning structure, whereas revenue is the result of the use of that structure. In Verriebe-Lachens, the company owned a hotel and they secured a contract with a foreign government to provide an extended period of accommodation. That contract was then cancelled and Verriebe-Lachens sued for compensation, which they then received. They then argued that the amount represented capital. The compensation that they received was capital. And the court said it's not capital because the income earning structure of your business is the hotel. It's the hotel that leads to your future revenue. What you're in fact being compensated for is the lost revenue which your hotel would have produced. So that's the definition of what capital is and what it isn't. The question is now, in a particular transaction, is the income capital or not? The primary case for determining capital or revenue is Stott. And in Stott, the court said the determining factor is the intention of the taxpayer when they acquired the asset, which they've now obviously sold and which has led to income. Their intention at the date that they purchased the asset, and whether there was any subsequent change of intention between purchasing the asset and selling the asset. Now obviously there must be some change in intention insofar as they've at least decided no longer to hold the asset anymore, and presumably no longer to generate revenue from the asset. But going down a few cases, in John Bell & Co., they said that we must identify something more than merely a decision to sell in order for there to be a change in intention. Now, it is possible to have more than one intention at the point that you acquire an asset or during the period that you hold an asset. And in COT versus Levi, they said in that case we look for what is the dominant intention. So for example, you might buy a property because you like the prospect of the rental income that it could generate. At the same time, you might be aware that the price of the property is likely to increase, and at the point that you decide to sell it, that you could make a profit on the sale. Those are both intentions with which you enter into the purchase contract. Determining whether the subsequent sale of that property is capital or revenue is determined by which was your dominant intention. Were you really after the rentals and you sold it as an afterthought, or were you really after the profit on sale and you were just renting it out in the meantime? So we can have two kinds of intention: capital intention and revenue intention. And in CIR versus Pick and Pay Employee Share Purchase Trust, the court clarified what a revenue intention is, and they said it's a scheme of profit making. It is a taxpayer that deals with the asset in question in a way that indicates it is the trading stock of that taxpayer. So in CIR versus Pick and Pay Employee Share Purchase Trust, the trust purchased shares for its employees, or for the employees of Pick and Pay, and they purchased those shares when the employees became entitled to them, and they had to sell those shares at the point that the employees resigned or retired. During the course of their operations, they made considerable profits. They were buying shares and then they were selling them. And the question was whether the profit on sale of those shares was capital or revenue in nature. And Pick and Pay Employee Share Purchase Trust successfully argued that what they were conducting was not a scheme of profit making. The shares were not their trading stock. And they argued this because they said that they didn't buy the shares when the price was low, and they didn't sell the shares when the price was high. They bought the shares when the employees became entitled to them, and they sold them when the employees resigned. The fact may have been that those transactions led to profits, but it was not the intention of the trust to trade in order to generate those profits. They were just following what the employees were entitled to. So Pick and Pay Employees Share Purchase Trust was not a scheme of profit making, but it shows us what a scheme of profit making is. On the other hand, in Stott, they said that the disposal of an asset that remains capital intention is one in which the taxpayer is merely realizing their asset to their best advantage. In other words, if a taxpayer decides to sell a capital asset, they are perfectly entitled to sell it at a profit, and they are perfectly entitled to do what is necessary to that asset in order to make as much profit as possible. So if a repainted house will sell for more than a house that hasn't been repainted in some time, a taxpayer is entitled to repaint the house without that action making it a scheme of profit making. Similarly, you're entitled to sell the asset in whatever means is most profitable. You're also entitled to advertise the sale or intended sale. You're entitled to generate whatever profit you can. At some point, however, you could enter into a scheme of profit making. Now, some taxpayers may have started out in a scheme of profit making all along, so we're not really worried about whether they are changing their intention. But other taxpayers might have started with a capital intention and subsequently had this change of intention that they talked about in Stott. And one case in which this happened was the case of Natal Estates. Natal Estates was a farming company. They farmed sugar and they had considerable plantations, and that was their intention, but at the same time they were aware that the demand for land was likely to increase. And at some point they decided that they could make more money by selling the land than they could by continuing to farm sugar on the land. So they decided to sell the land, much like Stott did. But the actions that they took were considerably more than those of Stott. So they subdivided the land into smaller plots, which, to be fair, Stott had done as well. They also cleared the land of the sugar plantations. They had the land rezoned. They had the land renamed. They developed a number of holiday destinations on these bits of land that they had. They also built example holiday houses, kind of thing that would entice buyers to buy and build similar houses. They also went on a considerable marketing campaign, and all in all, the court ruled that what they had done was convert their land into trading stock. Their subsequent actions were no different from those of a land developer, someone who would have bought land with the intention all along of developing it and selling it. And in fact, the court said that they had never seen a land development case with as much action that had ever been argued was still capital in nature. And the court said, the sum of your actions indicates that you've crossed the Rubicon. You have reached that point of no return where you have left the intention of capital and you have entered into the intention of revenue or trading stock. So when we're looking at a case, we need to look at a case that is initially clearly capital and say, is the sale of that asset merely realizing the asset to its best advantage, or has the taxpayer crossed the Rubicon and entered into a scheme of profit making? And the respective actions of Stott and Natal Estates give us an indication of what each set of actions looks like. When we're considering companies and a change of intention, there are two interesting cases that have arisen. One is that of Burea West Estates, and the other is that of Geldenhuys Farming. In Burea West Estates, there were a number of beneficiaries in a will, and those beneficiaries were collectively entitled to the proceeds on disposal of the land of the deceased. However, it was going to take some time to wrap up this disposal, so what the executors decided to do was to form a new company. That company would buy the land from the beneficiaries of the will. They would then sell that land, and as and when they sold the land, they would distribute the proceeds to the beneficiaries who are now shareholders in this new company. So the company bought the land with the intention of selling it. Normally that's revenue in nature. However, the court in this example said that all the company was doing was continuing the intention of the original beneficiaries. And so the intention of the beneficiaries was imputed onto this company, which continued this set of actions. And this kind of company is commonly referred to as a realization company. In contrast, in Geldenhuys Farming, Geldenhuys was a farming company, and at some point the shareholding in the company changed. The existing directors who were farmers left the company and new directors were appointed. These new directors were land developers. The new directors then proceeded to develop the land and sell it off at a profit. And in that example, the court held that the change of directors brought with the new directors a new intention. Now, some commentators have said that that is overly harsh, that in determining the intention of directors, we shouldn't look at their past actions, we should look only at their actions with respect to the current company that is under consideration. Be that as it may, in Geldenhuys Farming, they looked at the change of directors and determined that that could represent a change of intention. So intention maybe is a difficult thing to establish, and the question is, how would we determine a taxpayer's intention? Well, first of all, it's important to say that the onus of determining the taxpayer's intention or proving the taxpayer's intention rests with the taxpayer. That used to be Section 82 of the Income Tax Act. It's now Section 102 of the Tax Administration Act. What that means is that if the transaction appears that it may be revenue, SARS is entitled to treat it as revenue, and it rests on the taxpayer to prove that it's capital. Now, the factors that might be considered in determining the taxpayer's intention include the following. None of these is decisive, but together they would be weighed in determining the taxpayer's intention. The first, in Milan versus KBI, the court said that we would look at what the taxpayer's stated intention was. We would look at his or her ipse dixit, what he himself says. That's not to say that the taxpayer can say whatever they want and that will automatically be the result, but it is a consideration. The court also said that they wouldn't take that statement lightly, but they would then scrutinize and examine it. That's fine for individuals who are natural persons, but what happens in the case of taxpayers that are companies? Well, in CIR versus Richmond Estates, the court said that we would look at the action of directors in their capacity as directors, and those actions would inform the intention of the company. Interestingly, in CIR versus Richmond Estates, this is an example of where the company started with a revenue intention, i.e. they bought land with the intention of selling it, and subsequently changed their intention to a capital intention. They changed their mind and they started holding the land or the property with the intention of renting it out. They rented it out for some period and then they sold it. The court was satisfied that that sale remained capital. We would also consider the length of time which the taxpayer has held the asset. An asset that is bought and sold quickly is more likely to be revenue than an asset that is bought and then held for an extended period of time before it's sold. We would also look at the frequency of similar transactions entered into by the taxpayer. If the taxpayer routinely buys and sells the asset in question, then it's more likely that that transaction is revenue in nature. If it's the first time they've done it, that suggests that it might be capital. However, in Stefan versus CIR, the court did say that if all the remaining evidence points to a transaction being revenue in nature, the taxpayer can't, as their defense, say that this is the first time they've entered into the transaction. It's not that the first transaction is automatically capital, but the more frequent there are similar transactions, the more likely they are to be revenue. We would also look at the nature of the taxpayer's business. Is this transaction closely linked to what they normally do? Do they routinely buy and sell houses? Well, if they do, then the sale of this particular house is more likely to be revenue in nature. But if it's quite separate from their regular business, maybe more likely to be able to argue that it's capital in nature. We would also look and see what income stream had arisen from the period in which they held the asset. If the taxpayer is arguing that the asset is their tree, then logically we would say, where is the fruit? If there's no fruit, it seems like it might be their trading stock. We would also look at the reason for the sale. If the taxpayer is able to convince the court that there was some reason other than the pursuance of profit that motivated their sale, then it's more likely to be capital in nature. In CIR versus Nell owned Krugerrands, and he sold some of the Krugerrands in order to purchase a car for his wife. And he was able to convince the court that the reason he sold them was not in order to make a profit, but because he needed to raise the money to buy the car. However, in CIR versus Nussbaum, Mr. Nussbaum was the owner of a portfolio of shares. His stated intention in the portfolio was to own the shares in order to generate dividend income. And he stated that he only bought shares when they appeared to be paying a good dividend stream, and he sold shares when the dividends seemed to be drying up, or when it was a low dividend yield compared to the market price. The court looked at the frequency of the transactions and the history of the transactions, and they decided that in almost all transactions, Nussbaum bought shares at a low price, sold them at a much higher price. And they said that the motivation for his sales seemed to be the difference between selling price and original buying price. And they said that was enough for him to have a secondary business of share dealing. And the proceeds on disposal of those shares were considered revenue. We would also look at the manner in which the asset is financed. If the asset is financed through long-term financing, it's more likely to be capital in nature, or certainly it supports a capital intention as stated by the taxpayer. If, however, it's bought with money that needs to be quickly repaid, then it's unlikely that the taxpayer could hold that asset as capital. And finally, we'd also consider the nature of the asset. Is it the kind of asset that you could use to generate revenue or benefits? Or is it the kind of asset that is typically trading stock? Now, we did say that one person's capital asset could be another person's revenue asset, but some kinds of assets lend themselves more to one intention than they do to the other. So those are the factors that the court would consider. That's it for the general definition of gross income. But now, following the general definition, there are a number of special inclusions for items that don't meet all of the principles in the general definition, but it's been determined that those amounts should be included in gross income. So the next podcast is going to deal with that. Thanks for watching.